The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, everybody. Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of September 30th. If this is your first time joining us, welcome. We're glad you have found the podcast, and I hope you find it useful. My goal for this podcast is to use my background in economics to help you better understand the economy and the markets so you can achieve your financial goals. Now, with that said, let's hit the books and get up to speed on the markets. Last week, we mentioned three areas that we'd be watching this week: the PCE, the GDP, and the consumer confidence. So we'll start with a quick summary of those three. The PCE, or Personal Consumption Expenditure, is a statistic we use to help measure inflation. Last week's report, coming out of September, came in at 2.2%. The reason this is significant is because the Fed's goal for inflation is 2%. So being at 2.2 is incredibly close to where we'd like to be. It also helps us to understand why the Federal Reserve is shifting their focus from the fight against inflation to helping to make sure the labor market and the employment numbers are strong. The third and final revision for the second quarter gross domestic product, or GDP, also came in. It didn't change anything from the last revision. GDP still grew at a real rate of 3% in the second quarter. The third revision, or the final revision, is the most accurate. It has the most comprehensive data, and so this is usually where we believe that the GDP actually fell. The GDP report that was released last week was the third and final revision to the second quarter gross domestic product. GDP came in at 3%, which was not a significant change from the previous estimates, but this estimate is the final one that will be published prior to large-scale revisions in the future. Now our focus shifts to look to the future. The Federal Reserve has a forecasting model called GDP Now, and the GDP Now estimate for the third quarter is currently sitting at 2.5%. We'll get our actual first estimate of that value at the end of October, so make sure you tune back in and catch that update for that week. Last of all, consumer confidence. In the consumer confidence reports last week, we saw that consumers are still very apprehensive about the current state of the economy, especially around the labor market, but we saw ongoing and growing confidence about the economy 6 months from now. So although folks are concerned, they seem to have a little relief when looking forwards in time. Before we move into the data for this week, I'd like to pause and recognize the folks that have been affected by Hurricane Helene. Economics and finance at times can seem like just a bunch of numbers being thrown around, the highs and the lows, the gains and the losses. But behind all those numbers are real people making real decisions. People trying to find jobs, people trying to buy houses, and people whose lives have been completely upended by this hurricane. My heart goes out to the folks who've been impacted by this storm and the associated flooding, and I would like to just take a minute to encourage all of you to do whatever you can to help, whether that be donations, whether that be financial contributions, or if you happen to be in and around the area that was affected, helping to volunteer and send resources and materials to that area. It's incredibly important that we acknowledge the human factor behind and underneath the economics that we're talking about, and not forget that these real people will face real consequences of this storm for many, many months, if not years to come. Again, my heart goes out to those folks that have been affected. If you have the opportunity, please take a minute to try to help in any way you can. Thank you. This week's data is all about jobs. We've talked in previous updates about the Federal Reserve preparing to shift their focus from fighting inflation to trying to stabilize and maintain the strength of the labor market. Well, this week is our first chance to see where the labor market is and start to measure how the effect of the recent rate cuts impacts people's abilities to find and retain jobs. Early in the week, we received the JOLTS update for last month. And if you're not familiar with this report, JOLTS stands for Job Openings and Labor Turnover Survey. It's a survey that's conducted every month that focuses on the number of job openings, the number of folks that quit, and the number of folks that were laid off or separated involuntarily. It's an excellent way to see the actual churn, the flow in and the flow out of the labor market, as well as how employers are opening or creating new job opportunities. The JOLTS report this week showed very little movement from last week, although we did see a significant increase in the number of job openings that was unexpected among economists and analysts. While analysts expected somewhere around 7.6 million job openings, the actual number turned out to be greater than 8 million job openings. This is an increase of 329,000 new jobs over last month. Now, this doesn't necessarily mean that employment has increased, and in fact, the amount of hiring, the amount of quits, and the amount of labor turnover, being layoffs and separations, actually fell this month. So while more job openings is a good sign, it's not the only thing that matters. And in fact, at the end of the week, we'll get the more formal, more structured unemployment report from the Bureau of Labor Statistics. So this week, we also saw the wrap up of the third quarter. This is the period covering from July to September. Some excellent news came out of the end of the third quarter statistics. We saw that the S&P 500 had its best quarter since 2021, and we saw that the S&P 500 in the last months, or of the year to date, had its best year since 1997. The S&P 500 at this point in the year is up over 20%. The NASDAQ is also up 21%. The Russell 2000, which is typically used to study and monitor small cap or smaller firms, is up 10%. The Dow Jones Industrial Average is up 12% for the year. All of these are fantastic numbers. The question, of course, is what will happen in the fourth quarter and whether this success will continue. But we'll keep you up to speed. We'll keep you plugged into the markets. And every week we'll find out how we're doing. We also saw information updates in the manufacturing sector. And it's important to keep in mind that manufacturing is not one single homogeneous unit. Different regions specialize in different products and tend to have different experiences. So although what we're seeing in manufacturing more broadly right now is an ongoing contraction, in fact, according to the Institute of Supply Management, the manufacturing industry has contracted 22 out of the last 23 months. In spite of that, some of the regional manufacturing reports and certain industries are showing continued resilience and even growth in some cases. If the economy is to continue to grow and be successful in the rest of 2024 and into 2025, economists expect that we'll need to see this manufacturing contraction start to turn around. This also brings us back to a conversation from last week about China. The Chinese government and the Chinese central bank have grown increasingly concerned about the condition of their economy and has started to introduce massive stimulus measures to try to bring their economy back up to speed. It's important to mention this week because we saw the stock market in China increase in a single day on Monday by more than 8%. The takeaway being that the stimulus measures and the intervention on behalf of the Chinese economy seems to have inspired growing confidence and growing investment in the Chinese economy. I do want to reiterate why this is of concern to us is that China, after Canada and Mexico, is our largest trade partner. The Chinese economy has a significant impact on our agriculture, our commodities markets, our manufacturing sector, and our energy sector. So as we see the Chinese economy hopefully recover in the future, we should also see those associated U.S. industries growing and benefiting from that success. Last but not least, we saw the dock workers' strike start on Tuesday. Workers at 36 different ports from Maine to Texas have now gone on strike as their union continues to attempt to negotiate on behalf of higher salaries and job assurances in the face of interruptions by technology and automation. Although a dock workers' strike may not seem like a significant piece of the economy, 25% of goods and materials flowing in and out of the country on the East Coast come through these ports. This is a significant disruption to our supply chains, and this could pose, if prolonged, a significant financial impact on our economy and our ability to do business. In fact, JP Morgan Chase estimates that anywhere from $3.8 to $4.5 billion a day in economic activity could be lost as long as this strike continues. So as with all economic data and economic events, we will continue to watch the strike, and we will continue to bring you updates on the impact that that strike may or may not be having on the economy. Looking to the future, there's a few areas that we're going to be watching over the next week. The first one, of course, being the unemployment report on Friday. It's incredibly important because these monthly unemployment reports from the Bureau of Labor Statistics include not only employment and unemployment information, but they also give us information about labor force participation, which helps us understand how much of the adult population is actually participating in the labor force. And it provides additional information on the average hours being worked and the average earnings within our labor market. So a lot of good information, and we will bring that information to you in next week's update. We'll also be watching the housing market. With the recent Federal Reserve interest rate cuts, the question is, how will mortgage rates and the housing market respond? One possibility is that lower mortgage rates might entice homeowners who had previously low interest rates to now bring those homes onto the market, increasing the supply and potentially reducing that housing shelter inflation. Another possibility is that low mortgage rates might entice new buyers into the market and might cause upward pressure on housing prices. And of course, one more complicating factor is the recent proposal by the Harris-Walz campaign of a $25,000 housing credit for first-time home buyers to help with down payments. Although the election hasn't occurred, it is quite possible that a lot of first-time home buyers are watching the possibility of this tax credit and may actually withhold their demand or wait to buy a home until they have a little bit more clarity on what that tax credit may or may not look like, should the Harris-Walz campaign win the upcoming presidential election. All in all, the housing market is impactful, both on the economy and on the individuals within our economy, and we'll continue to watch how that market evolves. Last but not least, we'll be watching inflation measures coming from the Consumer Price Index and the Producer Price Index next week in order to get a good idea as to how our ongoing battle with inflation is going. And although the Federal Reserve's interest rate cuts typically work with a lag, meaning it takes some time for them to actually affect the market, we are now going to be watching inflation to see if the battle continues towards 2% or if we start to see a resurgence of potential inflation in the future. With it being the end of the third quarter, we're also expecting to see some influential earnings reports coming out of the private sector. Specifically, JP Morgan Chase and Wells Fargo will both release their earnings reports next week, which should start to give us an insight into how the financial sector has been performing over the last 3 months. This is the beginning of what will be, for the next few months, a very important and hopefully very insightful set of earnings data that will both guide our decision making and the future of the markets and investment. Thank you for joining us this week. As always, we'll continue to watch the markets and the economic reports to bring you the information you need to stay up to speed. If you found this information helpful, make sure you come back next week for our next episode, and don't forget to like and subscribe below. Thank you again for joining us, and have a great week.